any of you were to come to Harvard University over the past 10 years or so, you probably wouldn't notice me watching you. I'm a teaching fellow of applied ethics, and I look at what we like to say is Nash resilient equilibria on future human decision making, but it means that I look at how humans and tech are co-evolving. I watch how people move, how we grow, and how we build. And that means that I've gotten to do a lot of really interesting things like world-building economies 100 years into the future, and what does a drought in Boise mean for the future of a certain commodity in Brazil. But I never have the chance to really get to world build or to extrapolate or imagine with people I know. So I'm really grateful to be here and to introduce all of you to Barry Sternlicht. So the Barry that we know started with a few apartments, ended up building something that had 120,000 employees in 80 countries, held $9 billion in debt as a young father of 3.
You're talking about Starwood hotels.
Until you listen. And then became, you were at the helm of, at the time, the largest hotel company in terms of cash flows. And then they asked me to come and talk to you about where we are today. And so I can't track you if I couldn't stat you. And it quickly became obvious to our team that you were they started calling you a bunch of salty data guys. They started calling you the Leo Messi of REITs.
Okay.
And somewhere on a geeky server out there is a version of you that's tearing it up with Genghis Khan, and
Yeah, it was funny. I did realize I've been CEO of 6 public companies, which is like the first one I think I was 34 when I started Starwood Hotels.
When you were
34. Yeah, I'm older.
Well,
I have the same amount of hairs that I had then, though.
But
didn't fall off.
But it's interesting because when we start talking about where you are now, so we have a stat card. I want you to pay attention to these stats here, especially those bottom 2. Can you see that, Barry? This is something they made for you. You're in over 100 countries. You outpace the Fed. Vision's 99, because FIFA doesn't even give Ronaldo or Leo Messi anything more than 100. There you go. And then here's something really interesting that I started to see, is the $8 billion at the bottom left there, that's what you've allocated toward your data centers. This is something that was really curious, because I heard you talking about this at the end of last year, and you had said, casually, that it sort of came up on the radar, that you didn't realize that you had become the 4th largest in the world. Is that right?
That's correct. Backing up, I'm in the real estate business. Starwood Capital Group was a private firm founded in 1991. I spun off to run Starwood Hotels for a company we created back in 1995, I think it was. And I was chairman and CEO for 10 years, did the W Hotels and St. Regis as a brand, and took it to Bill Marriott to ask him to buy it when I was leaving, but he thought I was kidding, and then he wound up buying it a couple years after I left. But I went back to Starwood Capital Group, and my job is to invest in anything in real estate that we want through a series of opportunity funds. The last one was $10 billion. We're raising our newest fund right now. And if you look at our history as investors, we bounce from asset class to asset class, from multis to hotels to land to, I would say, office, but let's leave that for a second. Retail, out of retail. And one of the most exciting, and probably the most exciting emerging asset class in real estate has been data centers. So we wobbled into this kind of by accident. We bought some warehouses near Dulles Airport in Virginia. And the team felt that there was a nearby substation and we could get power. And so a $60 million original investment equity check will now be $3 billion. It's 455 megawatts, all signed up, all leased. And now we have to build this out, and we've now replicated that across the country. And in Europe, we'll be announcing, I think, a big deal this week in Europe. So, and expanding our footprint. And we added it up, turned out we were the 4th largest private owner of data centers in the country. And I'd say, did we get there by accident? I mean, the data center business is one of the places in real estate today where rents are rising. And in Loudoun County in Virginia, the vacancy rate is 1%. Everything that it does have power is getting leased. It is a weird situation, though, from an investor standpoint. There are only 4 or 5 major companies that are in this arms race. So you have Amazon, Microsoft, to some extent, Google, Oracle, IBM, ByteDance internationally. So
that makes you the largest private holder.
No. We're fourth largest private owner. So Amazon owns about half their fleet, and then leases the other half. But it is an arms race. These guys are deadly serious on having the footprints to serve the future.
Right.
And as you know, if you don't have power, you don't get to play. So power is the most key ingredient. Can you get the power? And of course, in many places in Europe, they have no excess power. So it is going to influence not only real estate, but also the growth rates of Europe, the competitiveness of European countries and Asian companies with our U.S. The advantages we have as a nation in the freedom of information are going to get more important. And it's going to, on the margin, it's going to really help the U.S. economy because we have power, because we have gas, and we have the ability to create power, and we have other less environmentally friendly sources of energy, but the gas that we have, which is virtually endless, will create the electricity that we need to drive the data centers that will drive the AI revolution through the companies that populate the stock market. So Europe does not have power. I mean, they're going to have to come up with new ways, whether it's renewables. We're doing some stuff in one of the European countries right now where Google's going to build a wind farm to power their data center. But it's not indigenous. They don't have gas.
Right.
And they don't have oil. So they have to bring in new ways of creating power. And I'm not sure anyone's really focused on a mini nuclear plant to do a data center. But obviously, Germany turned off their nuclear plants. So, and then in Asia, and then there's also the privacy laws in Europe, by the way, where you have to opt in. Well, that gives that's a big competitive disadvantage for European companies. If they're looking for European data, it's not as available as the data that the American companies have. And in China, they've kind of walled the country off completely. So they have a good thing for them. They've got 1.3 billion of them. They got a pretty big data set. It's just not global. It won't be as global. And I think this whole thing is going to get written in Congress at some point. Just as an aside, I mean, you've never seen an industry in my life, I'm 63 years old, that has begged the government to regulate it. Like, it's never happened before. Sam Altman goes on every stage and says, we need to be regulated.
Yes.
That's kind of terrifying, and that's another discussion for not the last 21 minutes of our chat. So.
And Sam was at Davos talking about exactly what you're saying, and he is actually making
He's only the person he's the only guy who could regulate himself. He should just go into DC take a sabbatical for 6 months and go figure out the regulations we need to keep us from destroying ourselves. You know, the fake news and the fake images and the fake stuff. I mean, your heritage is partly the blockchain. The blockchain, you know, may have to be used to verify images because it's the only way you might be able to know instantly whether what you're looking at is real. So you may have a validated trade through the ledger for an image, because otherwise we're going to have Putin, you know, shooting nuclear missiles, and everyone will be selling the stock market, and somebody will be short the market, and he put up the images. There are enough bad actors that we've gotten a long way away from real estate. So anyway, data centers are a very bright spot, and it's about 25% of what we do today, and becoming an increasing bigger share. We just agreed to take over a 30-person group, Mission Critical, that's actually has helped us in Virginia, and will help us around the world. And the other interesting question for investors in the data centers is the capital investments are so enormous. How are we going to get out of this stuff?
Right.
And none of us know for sure. So we'll probably see public exits, and these companies will go public. And data centers were around for a long time, but rents went nowhere. They were always a favored asset class, but the stocks, Digital Realty and Equinix, they traded at huge multiples. But if you look through them, their NOI growth was almost 2%. But now, because companies must have the power and must be able to service this AI revolution, there's been a sea change, and the actual rent they pay doesn't really matter that much in the scheme of things. It's kind of like, it's not that important. It's very important for us as developers, but not for them. It's going to be, there'll be mistakes. There'll be some accidents that will happen.
So can we stay on the data centers for a minute? Because I spend a lot of time out in Virginia horse country, and I do see what you're talking about. It is the data center capital of the United States, and they are huge. They are ugly, they are monolithic, and they take up some really great real estate.
Well, if you haven't had a chance to do this, land at Dulles and drive, 5 minutes,
Yeah.
8 minutes north?
West and north.
And you will think you're on another planet. It is, you'd say it's the future of the world. That was the center of the internet. 70% of the US's internet traffic was going through that county.
Yeah.
And right north of Dulles Airport. And so there was power there.
Data alley.
Data alley, and you see these giant, ugly buildings, one after another, after another, after another. I mean, obviously, computers don't need windows, they don't need sight lines, they don't need architecture. So the builders historically have taken advantage of that and built the world's ugliest buildings one after another. Where it gets to be really bad is when you're building a data center near homes in Phoenix or in Dallas. I mean, it's sort of gone. I mean,
not for me,
but people
but
are putting in trees now, and there are some more. Nobody cares. No, Amazon and historically, they don't care what the building looks like.
But the man who brought the world the W
Okay, we'll
to
paint
hotels
we'll
cares.
paint it a nice
tell me
color.
what you're thinking. I feel like you made that announcement last week. Where's your head with that? They are ugly, Barry, and they are huge. They matter to me.
It's something I think that they're beginning to pay more attention to, the exteriors. But nobody's spending any more money at the moment than they need to get the lease, and I don't think the tenants care, right? The tenants, there's only, you see these sites, we're building a couple of projects at the moment, and they're swarming with people, but when we finish the data center, it's like 15 people to run the building. So there's no humans that really, they'll make a nice little office for them and put in a large screen TV or something, but they're not human intensive. So, but I do think we owe something to the communities in which we're building these things. And there have been they're going 3-story now. I mean, these are ugly. So I don't know. We'll see what happens there. I just think you're seeing them wrapped in glass instead of being concrete boxes. You're seeing, if you go to Dulles, you'll see some nicer buildings being built now. But they're not beautiful.
They're not beautiful.
Racks don't really
For now.
require great-looking exteriors, but I appreciate your interest. So
I feel like that'll be the next announcement, is the W of data centers.
The W of data centers. I don't know if anyone will care.
So moving from the data center to the data, you've been famously outspoken about the data that you use. I think it's almost a meme now. Next slide, next slide, next slide on CNBC and Squawk Box. Oh. And finally, we saw a few days ago, Goldman's coming around to the position of the same softness that you're seeing in the market. Take a look at this chart, though. This is from The Economist 2 days ago. Can we show them here? And this is
the interest rates?
Yeah, exactly. This is what the market's anticipating from the Fed. We have the FOMC happening tomorrow, and you're not the only guy modeling this, but this doesn't look like consensus here. What are you looking at that the market and the Fed don't see
I've been
today?
if anyone's seen me talking about this, I've been very consistent since last spring that inflation was coming down. And I was very critical of the Fed because what you saw was inflation driven by too much money chasing too few goods. We filled the supply chain. You knew consumers would run out of cash at some point, and so prices would come down, which they're doing. And the biggest component of inflation is rent. It's an industry I'm in. We have 125,000 apartments. The Fed, every single metric they use in CPI is current. Energy, food, the one that's not current is rent.
Right.
And rent's on like a 14th-month lag. And last month they showed 0.5. It's the biggest component of inflation for the last, has been rent. The rents went up in 21. They went up 21% across our portfolio, and they didn't see it, because they're using stupid data. You would not run any company like this, you would be fired, right? And they should use current data. You know how many homes they survey? 8,000. You know how many I own? 125,000. If you call the public REITs, you'll get 2 million. You go to Fannie Mae or Freddie Mac, you get 6 million houses. Why do they run the government, which runs the entire world? Like when he raises rates, the rest of the world has no choice but to raise rates. Why do they use an algorithm developed in 1980, before the internet was born, for the most important component of inflation? So with absolutely no hesitation, inflation will fall below 2%. As soon as his rent component catches up to the data, and everyone's now talking about this except bobbleheads on CNBC, inflation's, it's here. It's not really here, it's coming down. X energy. If oil goes to 150 bucks a barrel because of something in the Middle East, all bets are off. And the current level, so the question is, when will the Fed lower rates? Because he's gonna have 350 basis points real interest rates. And here's where it gets really tricky, because the economy is too strong. It's too strong because of public spending. It's not too strong because of private spending. Private spending is rolling over. You saw UPS's numbers this morning. You've seen, in the last 2 weeks, you've probably seen 200,000 job layoff announcements at Macy's, Amazon. Everyone's laying workers off. The federal government's hiring them. So all construction should lose 1 million jobs. We raise interest rates 500%. We have a piece of land in Fort Lauderdale. We're going to warehouse it. We're not going to build it. The numbers don't make sense. Across the country, construction is plummeting. Industrial construction is down 70%. When we get through this wave of multis, which we're finishing, you'll probably have down 70% in multifamily construction. You would see 1 million construction workers unemployed, like you did in 07, 08. You've seen none. Why? Bridges, roads, and tunnels. The New Hampshire election, they're talking about, oh, we're building all these roads and bridges and tunnels. This is the infrastructure bill. It's $1 trillion bill. They're spending enough money to keep these guys employed, so you're not getting. So the Fed keeps using this really blunt, horrible instrument, 5.5% interest rates with two huge victims themselves, because we have a $34 trillion deficit, and it's going to run, the debt is going to roll over. A third of our debt rolls over this year. He can pay 5.3% on it, or he can pay 3% if he lowers rates. That's $200 billion. That's a quarter of the defense budget, which is the largest component of our budget. So he has a choice: pay $300 billion on $13 trillion, or pay $500 billion on $13 trillion. It's up to you, right? So it's 3% or 5%. That's one problem. Second problem is the regional banks. He's blown a hole through their balance sheets. $1.9 trillion of real estate loans in the regional banks. There's only $800 billion in the money center banks. And he blew their banks to garbage. Like, these banks are out of business. Like, they can't make money offering us 5.5% CD rates, right? So they're in serious trouble, and it's affecting there's a delay, but it's affecting business formation and lending. And if you go out to get a loan today, and we're in the business of getting loans, we borrow $30 billion a year, they don't show up. They're not even playing. Right. So the alternatives are the debt funds, which are having a field day. Because we go out send 128 books out to refinance a building that's 100% leased for 10 years in Nashville. And you get 4 bids, and they're all from debt funds. No banks, not one. And the debt funds want 500 over, which is 10% money, which means your building isn't worth a 10 yield anymore, or 6 yield, or 5 yield, or whatever you paid for it. So he's going to have the next crisis, if he doesn't lower rates, is a serious mess in the capital markets and real estate. And fixed income, not fixed income, infrastructure, anything that was yield related. So again, why is it a dull instrument? Half of the labor force that he's trying to kill can't be killed with interest rates. Half of our jobs today are healthcare, government, and education. In 07, 08, those 3 industries added 354,000 jobs. Like, it was the end of the world as we knew it. The banks were going bust. You had TALF. We all thought we were going to go, the Great Depression was happening. And those industries added jobs. There are 48 million jobs. And if you look at those 3 industries, they keep adding jobs. So he's only affecting the portion of the global workforce, the U.S. workforce, that is rate sensitive. Construction, I already told you, can't get it. Manufacturing, it's 15 million jobs. So he's going to knock 1 million out. I mean, you saw General Motors this morning. We had this auto revolution going on, and battery plants. He hasn't gotten. Manufacturing's flat, but it hasn't lost 1 million jobs. And then services, and that's what's happening now. The UPS, downsizing, all this stuff, that's where he can get the job losses he needs. But with interest rates, it was going to happen anyway. Inflation's down. Will he keep rates here? Yes, unfortunately. Why? He's leaving in January. Powell's out. He's not going to be the guy who let inflation come back. So I've once actually speaking right in front of him next week in Washington, so I better be nice. But I don't believe that he doesn't want his legacy to mean he blew it. So I see this morning's CNBC chart, 7% now for a March cut. I don't think we'll get the March cut. I think the data, as soon as inflation falls below 2, there'll be a lot of pressure on him. That might be May. So I think June, you'll see cuts. The question is, and rates will be lower, he'll have to lower them. It'll become very obvious that the private sector is struggling as the consumer runs out of money, which he still has. And why has this economy kept going? Not only his spending, people have jobs. And because they have jobs, the unemployment rate's so good, they're spending. And they're spending money they don't have. It's not in their savings account, it's all gone. And now they're on the credit cards. But they still, Americans are willing to live on a firm. Like, now we have new ways to spend money we don't have.
I want to talk to you a little bit about the jobs in terms of office spaces. I've heard you talk about the balance sheet issue, and we know there's close to $1 trillion of office space coming due. You've said a nice little recession is going to bring people back to these office spaces.
Happened today.
Exactly.
IBM said you have to go back to work.
So, but this is a uniquely U.S. problem, you say.
Well,
now,
we would have a problem in real estate, in every sector of real estate, not just office, because of the 500 basis point increase in rates that was vertical. The fact that one asset class never recovered, people never went back to work in the United States, in the office market has an existential crisis right now. And so, you know, it's a $3 trillion asset class that's probably worth $1.8 trillion. There's $1.2 trillion of losses spread somewhere, and nobody knows exactly where it all is. And Signature Bank was sold, and we bid on it. There were buildings in New York that were $100 million. The guy bought it for $200, the loan was $100, we thought it was worth $30 million. There's a building for sale right now in San Francisco, it was bought for $850 a foot, the loan was $450 a foot, they'll sell it for $250 a foot. I mean, that's 25 cents on the dollar. That would mean we lost 3/4 of the total asset class. Now, this asset class is not just owned by rich people, it's owned by pension plans and other people, small investors. We're not just talking about towers, we're talking about the buildings that surround towns and municipalities. But
what happens to those cities? What happens with
there is a
the
bright
places
spot. The office situation is a completely US phenomenon. I just was in Munich last week, and rents in Munich are up 15%. The vacancy rate in Munich is 2% for Class A. In Seoul, Korea, it's 1%. In Tokyo, it's 4%. Everyone's back to work except for Americans. We've gone off the deep end. We don't show up for work, we don't apply for jobs, and we don't feel like we have to go back to the office. The CEOs are in, and I think in a recession they will say, as you're seeing right now, come to the office. When Amazon opened HQ2, they said 4 days a week in Virginia. Right. So what will happen in municipalities is another impact of the Fed. This is a suicidal mission he's on. I mean, I just think this is crazy. And the unintended I want to fight inflation, but the unintended consequences of what he did are gigantic. And they point out, you know, I was at a conference with a well-known firm the other day, and they got up, it was a real estate roundtable in Washington, the economists got up and said, we're having $1 trillion deficit this year. It'll be $2 trillion. The deficit will hit $2 trillion, maybe through $2 trillion. And the biggest miss of the OMB did when last year's budget went to $1.2 trillion or something was 180 billion miss on receipts because nobody's selling anything. So there's no capital gains and values were down. So that's also, there's not only do you have to pay higher interest expense, but you're losing revenues because values are going down and people aren't selling. They're holding on to stuff and the values are down. So the government is playing.
Can we talk about that? The survive to 25?
Well, so the brutality of what's going to happen to New York City and San Francisco and Los Angeles is that they rely on the property taxes of the commercial buildings to run their cities. That's how they pay for the police and the firemen and the educators and the trash removal. So when the receipts plummet, you get into this, and now what do? They'll increase the mill rate. So if I'm paying $1 million today, but my hotel's worth, not my hotel, let's not pick on hotels. My office building's worth a third of what it was, and we say we need relief. Normally we'd get that. Now they'll say, it's $1 million, your mill rate just tripled. Because they can't lay off, which means the building even goes down further in value and it is abandoned. So right now, the office markets are funny because you want to give your building back to the lender and they don't want it. They won't take it. Like, you take it. No, I don't know. You take it.
Nobody wants to hold the assets.
Because it's capital intensive. And we look at every building now that we own and we say, should we put the money in for the tenant improvements? And the tenants are smart. They're like, if you want me in that building, I want $200 a foot to fix out my space. Well, the building's only worth $400 a foot, so maybe I got to buy the building for $200 a foot. It's going to be fascinating. And people will make a lot of money in the office markets because they're not going to be empty.
But
they're
some
just
of
going
those
to have a lower vacancy.
17% in Chicago is coming due. How do these cities survive this? You're talking about, like, what happens to these B and C class buildings? They become like...
They're going to rely on the government. The federal government will come in with some credits to help people convert or tear down buildings and turn them into residential, which we desperately need. And the cities are going to have a problem. The big blue cities that are not working, they're not working for, I mean, I don't know anyone, I haven't met anybody who thinks what's happening in San Francisco is good. You know, but it's not good. And then retailers leave, and these cities become ghost towns, and we'll go through the Detroit cycle. And maybe there'll be a guy like Bedford Properties, I forgot his name now, who came in and bought all of Detroit. He owns 85 buildings downtown, Bedrock. He bought the Cleveland Cavaliers. What's his name?
Gilbert.
Dan Gilbert. So there'll be a Dan Gilbert in San Francisco who'll buy 85 buildings for $200 a foot and become the price setter. That's what's going to happen in all these office markets. Everyone will be the Saudis. Somebody will have a building at $150 a foot when everyone else paid $800 a foot, and he will be making rents of $20, $30, and everyone else's wants $80. So he'll be full. If you bought a relevant building, what's really interesting in Europe is you can kind of sometimes see the future in Europe. In Europe, if you don't have an ESG really compliant building, nobody will take your building no matter what the rent is, and you cannot sell it. So I think capital is getting very smart. It's going to pay a lot more attention to the energy footprint and the ESG compliancy, and tenants want to be in the newer, better buildings. Across the street from
they're they're occupied. They're doing well. Those A-class. Really.
The best buildings in most cities are full.
Yeah.
That doesn't mean anyone knows what they're worth, but they're full. And the real worth. Tell me what the financing markets are. There is no banks in the United States, money center or regional, that want to make an office loan, Nobody wants to go into an investment committee and say, I have this great opportunity to lend against an office building. You will see MetLife, you'll see the life companies at 40%. And what's the value? What's the V? What are you lending against? What's the cap rate used on the building? These buildings in New York were 4, 5, 6 yields. Now, I can't, and I don't know when they come back to 4, 5, and 6 yields, even if he lowers interest rates. Lowering interest rates will certainly help the multi-markets enormously, will help the industrial markets, will help the hotel markets, which are not fundamentally broken. Actually, the real estate market in general is pretty sound. What has really happened, and we have a wave of multis on the back of that, there won't be a lot of multis. So what's really happened is, like we said, a balance sheet crisis. Right. The balance sheets are wrong. And when these caps that we have in place roll off, there's explosions everywhere. There's been like, I got the stat yesterday, there's something like 3,000 mods.
When you make those bomb sounds and then you like laugh at not laugh, but
I'm not
you do
laughing.
the smirk, I know,
just
like
think
scares me.
I think Powell's living in a cave. So I don't, and he wants to be the guy who slew inflation, and he created $1.5 trillion of losses and crippled the regional banking system, which was needed for capital formation. The other unintended consequence, which is severe, is he's causing a serious drop in homes, the number of homes being built. So he's trying to get inflation down by lowering rent, but he's creating the future of higher housing price growth and less affordable housing, because the supply of homes is getting cut. We only had 4 million existing home sales, down from 6 million. Nobody will sell their house because they have a great mortgage written at 3.5%. And then single-family home construction's plummeted, and you don't see it in the public data. The public companies are doing okay. They're down. I mean, their starts are down, but they're stealing share from all the small guys who can't get any capital at all. So what you see is publics that have big balance sheets that can finance off their balance sheet, but the small regional builders that are the majority of the housing market are out of business.
So speaking of housing and capital, I did want to get your opinion on something that I read last week about Adam Newman and Flow. He basically is at a place where he can't service his...
You're so current.
I'm trying so hard. You should...
Go ahead.
I was stalking you with your...
Do people know what Flow is? Adam Newman went into business with, I guess, Andreessen Horowitz. That's right. And to build a different version of a multi with, I guess, yoga classes.
But you're a vibes guy. It was working. Rents were, I mean, they were filling. People, the idea is that you would sort of pay a premium for these.
Apartments nationwide are running 95%.
So what would your advice be to Adam Newman today?
Well, Adam has the same issue we all have, which is what did he pay for the building? What yield did he buy the building at? And what's it worth today? So, Adam's trying to get a premium for his services. In hotels, I do 1 hotels now, and I'm getting the highest room rates in the competitive sets. And we're crushing all the existing brands in every market we compete in. It's based on design. Is there a barrier to entry in what Adam's doing? I'm really not familiar exactly with what he's doing, but if he's doing yoga classes and health clinics, the building next door will do yoga clinics and health clinics, yoga sessions and health clinics. I'm not sure it's a real moat. I don't know enough about it. I was sort of surprised to see Andreas and Horowitz fund it. And Adam is, as you know, I know him well. I mean, he is a force of nature and an incredible salesman. So he'd be fun to hang out with. I actually see him occasionally. I haven't seen him in a while, but anyway.
I get to ask you one last question, and it's something that I think I've always wanted to know, and it's probably one of the top 3 things that people want to ask. If you could, it's one of those it's my Walter Isaacson moment. If Barry Sternlicht today could give advice to young Barry Sternlicht, who had just sold his first, just completed that first transaction with Sam Zell, what advice would you give that young Barry?
It's a great country. I mean, there's an incredible opportunity. Find something and work hard at it. Be passionate. Find something. There's always something to do. You just got to find it and work hard. There's nothing that makes up for hard work. It's much more fun to get lucky. We all love to get lucky, and it's easy to get lucky. You set yourself up to get lucky. Luck is when preparation meets opportunity. So I got accused of being lucky with the paired shared REIT, which is how I grew Starwood Hotels, and that wasn't luck. We knew what we were doing when we took control of that vehicle, that paired shared bankrupt company on the New York Stock Exchange that no one else found. It's just something we went after, and nobody else cared. But I knew investors would care, and we became the largest hotel company in the world, as you mentioned, measured by cash flow in 4 years. So, but nothing makes up for work. But in this country, you can do anything you want if you set your mind to it. And to the young people, keep your ethics. Your name is the last thing you have and the most important asset you have. So you never get to recreate that if you screw up.
I love that, Barry. Thank you so much.
Thank you.